So dear student, we are starting the section C of the same part 1. Under section C, basically it is about performance management, how you can measure the performance. So when we see about how to measure the performance, basically we will measure the performance with some established criteria. For example, some established standard we make, some KPIs we make. So we will be comparing with that. So in that, like chapter number 1, the section C is basically cost and variance measures, right? We will see so many types of variance analysis, etc. Then we will see responsibility centers and reporting segment. Basically, you know that when I say the sales performance, the sales performance, like you would like to somebody responsible for that, so that you make the different centers, responsibility centers, for example, revenue centers, so that they will generate the sales. So you will give them responsibility, and then you will see whether they are performing well or they are not performing well, etc. Whereas in finally, performance measure is the third chapter that we will see under so many methodologies and so many analysis that we will be calculating. Anyway, let's come here. We are starting right now chapter number 1, or if you see in the CMO book, this is the chapter number 15th and section C, chapter 1. So cost and variance measures. Basically, we prepare the budgets. We prepare the budgets, and budgets we prepare keeping some standards, right? So we have already discussed in the previous chapter that we make the, first of all, the revenue budget, that is sales budget. Then we prepare the production budgets. Who sent the message to me? Wait a second. Okay. Anyway, so variance analysis we will do. We will find the material variance, labor variance, overhead variance. All the variances we will be calculating. Once you calculate the variance, right, either you will perform better than the standard you set, right, or your actual will be better than budgeted data. So then it will be favorable variance. And if you are performing not better but worse than the established your budget, etc., this will be unfavorable variance, right? So many times we say that if it is unfavorable variance coming, then only we will try to do scrutiny and see whether the company, why the company did not perform well. But basically, even if you have the favorable variance, you must see that what was the potential to go beyond the budget, or to get more better results we can get, right? So that's why we will also do the scrutiny of the favorable variances as well. So unfavorable variance: under efficient condition, a worker should complete 1 unit of product per hour. 1 unit, 1 hour. If workers are normally paid $6 per hour, standard labor costs will be 6 into 1, $6. If the actual per unit amounts for a 1 week period were 1.1 hours at 6.25 or 6.88 per unit, variance is 0.88, right? If your standard budget you set $6, but actual came $6.88, so is it a positive or negative? This is a labor budget. $6 came basically 6.5. Is it good or bad? $6 budget, actual 6.88 labor cost. Good or bad? Farid, where are you?
Sir, this is unfavorable. Unfavorable, sir.
Unfavorable variance.
Actual is more than the budgeted cost.
Yes, that's true. So anyway, Okay. So let's see now. Basically, we see the management by exception, right? So management by exception, when we see it, enables management by exception, the practice of giving attention primarily to significant deviations from expectations. So it means that if, let's say, material price increase very little, so you will not take much action. If the variance is coming very little, but you might said that if the variance come, let's say 2% or more, then it should be management by exception report should go to supervisor. But if it is 5% more, it might go to the manager, production manager. If it goes to 8% or more, production director. So management by exception. So if the exception results are coming, then it will be reported. So concentrating on operations that are not performing within the expected limits, etc. Static budget, when we see static budget, basically we are looking that actual result we will compare with the our budgeted data. Actual result means actual input. Let's say if we are calculating material, so material price into material quantity, right? For example, you're making some chairs, so you'll say square foot of the wood. So this is actual result will be actual price into actual quantity, whereas static budget will be budgeted input into standard price, right? Budgeted input means how much wood. Normally we said that in a chair 10 square foot of wood will be required, so this is budgeted input. And standard price, each square foot of wood, let's say we'll buy for 10 dirham, that is the standard price. So it means if you are comparing actual with the static, actual with the static, this is called basically static budget variance. Basically this is called static budget variance. So static budget variance consists of a flexible budget variance and a sales volume variance, or in other words, right, we can say it measures the difference between the static master budget amount and the actual result. So here we can see this is the actual result and this is the static budget. If you compare both of them, let's see here. Here we have data. This is our actual results. And here we have standard quantity into standard price. This is the static data, right? This is the budgeted data. So here you can see standard quantity into standard price. This is the static budget. So if you will compare, let's say your revenue was 2.16 million. That was budgeted, but actually it came 1947. Is it good or bad? Revenue actual is less. Good or bad?
Of
Of
course,
course,
it's bad.
it's bad. It's unfavorable variance, right? How much
Yes.
unfavorable variance? 2,160,000 minus 1,947,000. It means 213,000 unfavorable variance. So, but you know that in that we are only looking at the static budget variance values and actual budget varies. In terms of revenue, we have seen the static budget variance, we did not perform well. As far as the here we see the material cost. So our actual cost is 750 and budgeted cost was basically 911,000. Is it good or bad? Favorable or unfavorable? Actual
This is
material
favorable.
cost is low. This is favorable, right? By 160,000 around. Whereas if you see the direct labor cost 297, but actual coming 321, is it favorable or unfavorable?
The cost is more, so that's
Hmm.
unfavorable.
Actual is more, that is unfavorable. So remember, revenue should be more in order to make favorable, and cost should be less in order to be favorable. All right. Anyways, the same sales minus variable cost means material, labor, and variable manufacturing overhead. This is coming total variable cost. So you can see basically this is the difference of your total budgeted cost, or you can say standard cost, right? Minus the actual cost. This is the over that. Now we are coming to the flexible budget variance. Basically, if I give you example, suppose somebody budget was made for 1,000 chairs, right? If a budget was made for 1,000 chairs, and if I say, right, for 1,000 chairs, right, each chair will use 10 square foot. So we say, okay, come on, that is how many square foot we are using? 10,000 square foot, right? I believe you can see it properly. So 1,000, right, square foot. Uh, Standard quantity, standard price, right? Or let's say number of units and input per unit. Okay, number of units, input per unit. Okay, so and total quantity of material, right? So number of units you're making, right? Or number, so 1,000 square foot and input 10. So it becomes 10,000, right? This is the standard data is there. But when it comes the actual data, when it comes the actual data, the standard we said number of units 1,000 and 10 is the per unit material. So total material will be how much we discussed 10,000. Fine. But what happened actually, number of units what you are making, right? A number of units or number of chairs, let's say you are making, let's say you are making 800 chairs. Okay. And on 800 chairs, like actually you used, let's say 9.5 square foot per chair. So what it will become now, or make it actually you produce 1,200. Yes. Tell me, is it good performance or bad performance? Means number of units or number of let's say chairs you're making. So let's make it simple. Number of chairs you're making, that is 1,000, and how much wood is required in one chair? 10 per square foot. So total 10,000 square foot of material. Now actually is basically you are making 1,200 chairs and you are using 11,400. So if I will calculate the static budget variance, right? Static budget variance, right? If I'll calculate the static budget variance, what I'll come to know that basically how much variance will come? 11,000 minus 10,000, it means, is it positive or negative? Yes. Is it positive or negative? Total quantity 10,000, actually we use 11,400. So is it good or bad? We use more quantity. Is it good or bad?
And we
Hello?
produce also more chairs, so in a way it's good.
In static budget variance, basically, if you see static budget variance, you will see basically you are using 1400 more material. So that will look unfavorable. That will look unfavorable, right? So that will be unfavorable. But if I want to calculate the flexible budget, how to calculate flexible budget? Basically, in order to calculate the flexible budget, we will see that, listen, although we mentioned this, let's say 1400, if I say that is unfavorable, as I mentioned, this is unfavorable, right? 1400, I mentioned it is unfavorable because I used more material. But in reality, actually, we are doing more production. We are producing more chairs. If you are producing more chairs, obviously the raw material quantity will come more. Obviously, the raw material quantity will come more. So in flexible budget, basically, what we are doing basically in flexible budget, uh, in the flexible budget, basically, we are doing actual input or actual quantity times standard input. Okay, this is the formula that we will follow. Flexible budget, actual quantity into standard input. So how much actual quantity we have? 1200, right? And standard input is how much? 10. Standard input is 10. So we will multiply it by 10. So that will come how much? That will come that actually if I produce 1200 chairs and each chair requires 10 square foot, so we would be using 12,000 square foot of material, right? So under flexible budget, right, it mentioned that we would use 12,000 square foot, but in reality, in actual, you are using 11,000. So if I'll calculate the flexible budget variance, if I'll calculate flexible budget variance, so what I will do, I will say, right, how much is that? 12,000 minus, or let's say 11,000 minus 12,000. 11,400 minus 12,000. So 600, our flexible budget variance. Is it coming positive or negative? It is coming positive. It is coming positive. So how we'll find out there, right? Actually, you produce that 12,000 minus 11,500, 400 is that. 600 is flexible budget variance is coming. Farid, you understand that point?
Yes, sir.
Farid, are you there?
Yes, sir. Yes, sir. I understand.
Saqib?
Yes.
Saqib, are you there?
Yeah, I'm listening.
Saqib,
Hello.
what happened to you people?
Hello.
Sir, you
Let
can
me
hear us, sir.
tell you
Saqib.
again that standard, you have basically number of chairs you want to make 1000, and you make a standard for 1000 chairs, right? Each chair will require 10 input for one chair. So that is 10,000 square foot you need. Actual, when result came, you come to know that actually instead of 1000 chair, actually you produce 1200 chairs. And on average, you use 9.5, it means 11,400 square foot of material actually used. If you will compare this actual and standard, you will say there is a variance, that is static budget variance. Static budget variance means that you will see that the estimated and actual difference for 1400, you have used more quantity of raw material. So that's why it is unfavorable. 1400 unfavorable. But actually, how you can compare if I ask, for example, you are the labor and I say that your budget is unfavorable, you have more use more material, you will say, sir, you had asked me to produce 1000 chair, and this 10,000 quantity is basically for 1000 chair, whereas actual quantity, actually I produce not 1000, I produce 1200. When I produce more, of course my material usage will be more, so that's why I produce more. My quantity is basically 11,400. So because I produce more, so raw material will be consumed more. So you should not see static budget basically in this case. For that, we will prepare the flexible budget. So under flexible budget, basically what we'll see, how to prepare flexible budget means in flexible budget, we will be seeing actual quantity, that actually whatever we produce multiply by standard input required. The standard input was 10 per chair raw material, right? Actual was 9.4. So what we are doing, we are taking 1200 actual, right? We are taking 1200 there, and we are taking from there, right? So 1200 into 10, right? Once you will do 1200 into 10, right? Standard rate and in standard input and actual quantity. Once we will take it to 1200 into 10, that will come 12,000. Basically, it will come our flexible budget, right? So actual input, actual quantity multiply by input per unit, you will take a standard, that is 12,000. Now you'll say, sir, basically, if I have produced 12,000 unit, according to your standard, I should use that 10 square foot. If I use 10 square foot on 1200 unit, so I should have consumed 12,000 raw material, 12,000 square foot. But in actually, I have only consumed 11,400 because I have consumed less. That's why it's 600 is the favorable variance. I hope you will understand that.
No, no, I understand. Sir,
This is
what if,
basically our
sir,
flexible budget and variance. So here, this is same we
sir,
have done basically here, that we
sir,
have calculated the flexible budget variance, right? Flexible budget
can
variance.
you hear me, sir?
Here, basically, we had how much quantity? Actual results were 16,500 unit.
Sir, can you hear
Right?
us?
Whereas the standard unit were basically how much? 18,000 unit, right? So actual were 16,500, whereas standard units were 18,000. If you want to make basically,
Can you hear me, sir?
what happened?
Sir,
Hi, sir. What? Hi, sir.
sir, I am speaking, sir. You couldn't hear me, I think.
No, I can hear you now, but I don't know.
Sir, before I was talking, sir, I think you couldn't hear me, sir.
Yeah, I could not hear at that time. I don't know why. Anyway,
Okay, sir. So can you go back to the Excel sheet, sir? I have one question.
okay. Yes.
Sir, see, now we produce more than the standard. What we set the standard that we will produce 10,000 chairs, but now we produce 12,000 chairs.
1200, yes.
So what? Yes, 1,200 chairs. What if we produce only 900 chairs? Then and we consume less input,
Yes.
9.5, and we just produce less shares. Then again, what will be the consequences then? I mean,
Let's
it
say
will be
if you have
favorable.
900, if you have
Yes,
900.
sir. Yes, sir.
So what you will do, basically you will do same here 900, right?
Okay. Yes,
And
sir.
multiply by 10, it should be 9,000, right?
Okay.
So in fact, we are using
Less.
actual, we are consuming
Okay.
less material compared to the.
Yes, sir.
Sometime
Okay.
it may happen that you are not using 9.5, you might use 11 or 12,
Okay. Then it will be unfavorable, sir.
then it will be unfavorable. Let's see this situation as well, right? So in this situation, what will come? Let's say if I say that is in fact you are using 11.5. This is scenario. So here I should keep 11.5. right? So in this case, we can see, sorry, 900 into 10, sorry, 900 into 10, same. So flexible budget 9,000, but actually we use 10,350, right? So here we can see that we are performing not good. It is unfavorable. We are using what we should use considering the standard set. Basically, standard set was 10 per unit, right? The standard was 10 per unit. If we consume less than the standard, just like in this case, so it will be favorable variance. If we consume more than the standard, 10 per unit, right? So it will be higher, right? Do you understand, Farid?
Yes, sir.
Okay, let me give it a arrow here. Okay, later on I'll do it. Right. So anyway, this is about discussed about flexible budget variance, right? Flexible budget variance, and here I was telling you basically static is 18,000, actual is 16,500, right? So if you want to make the standard flexible budget, so what you will do, basically you will take the actual here 16,500, right? 16,500, at that you will be making the budget. So let's say if I take the material, so material we have to see in the static budget how much input is mentioned. Let's say if I say 911 divide by 18,000, right? So material standard we have to find out here. Material standard is not given, but if it is that is there, so I can find out the material standard easily because my material cost is 911 to 50. Standard material cost is 911 to 50, right? That I will divide by how many units? 18,000. Divide by 18,000. That's coming 50.625. 50.625. If that I will multiply to my actual number, that is 16,500, multiply by 16,500, so that will come how much? 835,313, right? I hope you understand that how we got these values, right? 835 flexible budget. How I got flexible budget? That here, because the figure was given, so here simply you are deducting how much, that here actual budget minus flexible budget. So flexible budget value when they have given, so flexible budget variance you can calculate easily. Understand? So we got the 835 minus the actual. This will be the difference coming. So if I minus 750, 750, 750, what is coming? 84,562. 84,562. This is the variance that is coming, right? I hope you understand. So basically, if you have the actual result, you have the flexible budget results, so you can minus actual and flexible. This is our flexible budget variance. How we will be calculating the basically material variance? Let me come to the Excel sheet. Here is the formula sheet basically that you should follow. Okay, material variance. So what is that? I will tell you the two formulas that you have to remember, and the same formula will work in material, labor, variable overhead, even in the sales variance as well. It will work, right? In the two formulas you remember, and the same formula will be working in all of them. Basically, for material, we have two formulas. One is the price, the other is quantity. Two formulas, right? Material price variance, material quantity variance. Material price variance, basically, it's same as labor rate variance. Either you call labor rate or labor price, it's same. Variable overhead, also same. Sales price variance, also same. Formula is basically same. For all these four, price variance is the same. Let me tell you how. See, if I tell you that material price variance, so variance will come, right? Change in the price, change in the price into actual quantity, change in the price of material price, right? Change in the material price into actual quantity. If you see the labor rate variance, this is also the same. Change in the labor, right, into actual hours, right? So labor rate, if you say change in the labor rate, or you say material price, basically both of them are the rate, right? So we can see that change in the price multiplied by actual quantity. Here is actual hours. Basically hours are also quantity, right? So we can say either you can material quantity or you say labor quantity, it's the same. Similarly, if you come to the variable overhead variance, so variable overhead variance is also the same formula, that is variable overhead rate, right? Change in the variable overhead rate multiplied by actual hours. Here was labor rate, here is variable overhead rate, but the formula is same, right? Similar, if you come to the sales price variance, it is also the same. Change in the sales price multiplied by actual quantity of number of units sold, right? So what is the formula for price variance? Simple formula, price variance formula. What is the formula? Anybody can tell me? Price variance formula.
The standard price minus actual price multiplied by actual quantity.
Change in price, right? Change in price into actual quantity, right?
Yes, sir.
Basically, both the formulas, all four formulas, these are all four formulas are same. Change in price into actual quantity. Am I right? If you are calculating material price variance, to change in material price. If you are calculating labor price variance, basically labor price variance in terminology we call labor rate variance. Even if you say labor price variance, it is not wrong. It is not wrong. In different books they use the different terminologies, right? So basic formula, price formula is change in price into actual quantity, and this same is applied up till sales price variance. Agree? Same is applied up till sales price variance. So remember this thing, right? So basically I'm telling you two formulas. One is the price formula, the other is the quantity formula, right? Did you understand? Same is change in labor rate into actual quantity, means actual hours. Same in variable overhead rate into actual hours. Same in the change in the sales price into actual quantity number of units sold. Same is applied, right? So remember, this is the price variance that will work. So now let's see if we come to a question. If we come to a question here, here is question. Material. If you see here, what you can understand from here, you can understand that material, they have given 60,000 units of material at $2. This is standard cost. So what is standard price? 2. Actual cost, how much price? 1.9. So standard quantity 60,000, actual quantity 70,000. Our formula was what? Change in price means standard price minus actual price, right? Standard price minus actual price. So standard price is how much if I want to calculate. Our formula is very simple. Standard price minus actual price into actual quantity. This is the formula. So what is the standard price we have here? 2 or 1.9? What is standard price? For Saqib,
Yes, sir.
what is the standard price? $2 or 1.9?
Actual. Standard this one, sir. 2.
Actual is 1.9, right?
Yes.
So if I'll do what I will do, standard price is 2 minus actual price 1.9. And how much actual quantity? 60,000 or 70,000? Or 600 or
Actual quantity 665.
no, that you're looking labor. I'm talking about
Yeah.
material.
No, 7. Sorry.
700, right?
Yes.
Okay. So 700,000. So simply I can do what? That my standard rate is 2 minus actual rate 1.9 means change in the price into actual quantity of material is what? 700,000. So if I'll multiply 700,000, it will come 70,000 favorable. Is it okay? Fine.
Yes.
So if I give you a question, right here I am giving you a question. Let's say a rate and quantity. Okay. Standard actual. Okay. You have to find out the variance basically. So let's say standard rate is 15, actual rate is 18. Quantity is 1000, here quantity is 1200, right? So what is the formula? What is the formula? Material price variance. What is the formula basically? Standard price, actual price into actual quantity, right? What is standard price?
15, sir.
15. Actual price
18.
18. Actual quantity
1200.
okay. So standard minus actual will be how much?
-3, sir.
Minus 3. Actual quantity is how much? 1200. So what will be material variance then?
3600 minus.
Material price variance, right?
Yes, sir. Minus 3600, sir.
So is equal to 1200 times minus 3. Unfavorable 3600, right? This is the way we calculate the material price variance. Saqib, you understand this point?
Yes, sir.
Hmm?
Actual quantity.
This is quantity, right? This is standard
Yes.
quantity. This is the actual quantity, right? Okay.
Okay.
So standard price rate is standard rate is what? 15. 15. Actual 18. 18, right?
Right.
Into actual quantity, right? What is the material price variance formula? Formula is what? Standard price, right? Here, if I
Actual
write
quantity.
down in the bracket, standard price minus actual price, right? Into actual quantity, right? This is the formula, right? Standard price minus actual 3 minus 3 multiplied by 1200. This is okay. We calculated that formula. Now let's say if I apply the same rule, right? This is, let's say I mention you material. Now same if I tell you about the labor, right? What is that? here I will write down hours. In labor, quantity is called hours. Okay. Now, if I change, let's say, if I say standard rate, how much is there? Let's say 20. Actual rate is what? Let's say 18. And how many there? 2000. And here is 1800. So can you find out the labor rate variance? Formula is basically same, right? I told you quantity, either you call quantity or you call basically now I'll call labor, right? The formula is called labor
Labor rate variance.
rate variance, right? Standard price, or here I can write down price is also okay. Let me write standard rate minus actual rate into actual hours. Instead of quantity, I can write down actual hours. Okay, this is the formula. So can you calculate the same way I did it?
Yes, sir. Sir, the answer is favorable 3600.
Same? Amazing.
Favorable? No, sir, favorable 3600.
Okay. What is standard rate, Sakib? Sakib, standard rate.
Standard price 15, sir.
Where?
Material
Labor. We are doing the labor. Why you are telling me the material rate? See
20,
here,
sir. 20, sir.
20. Actual rate,
18.
actual hours,
Actual of 1 8.
800. So what will be the amount then? Standard minus actual. How much will come? Plus 2 or minus 2?
36, sir.
Why 36? 2. Here 2.
20.
Here is 1800, right? And
Yes.
finally, we can calculate 1800 times 3600. So you are telling me the last answer, right? This is
Yes.
our, we can say labor rate variance. I can say labor rate variance. Okay. This is the labor rate variance. Simple example, right? Now, same if I consider here, same thing I consider here. Now, let's say instead of labor, if I call variable overhead, right? Variable overhead. So here rate will be, of course, you can say variable overhead rate, right? And here will be what? Which hours? Labor hours, or which hours I should take? Labor hours or direct labor hours or indirect labor hours in variable overhead?
Indirect, sir.
Indirect.
No, no, sir, we will take labor hours, sir.
But labor hour include direct and indirect. So which labor hours? Direct labor hours or indirect in variable overhead? Fareed.
Sir, I think we will use direct labor hours.
Yes, this is the
No.
most important thing. The students get confused. They say overhead, it is indirect. Overhead cost is indirect. We should take indirect labor hours. No, no.
Why,
Overhead is
sir?
indirect, but you should take direct labor hours. Yes, Dr.
Direct labor hours. How can, sir, we take?
Because indirect labor hours, let's say helper, right?
Yes.
Helper hour there, but normally overhead is related, right? As much production is going on, so that much labor hour will be there. You got the point. So variable overhead will be based on direct labor hours as much,
Okay.
because production is basically going on by the direct labor, not the indirect labor. So variable overhead relates to so many things that relates to basically direct labor hours. Understand? So remember this
Okay,
point.
sir.
So here, if I change the rate, let's say if I say 5 and actually say 4, and here say let's say how many hours I'll take? I have to take same, right? Remember this thing. If we are following the same, the hours will be same. Understand? So remember this point. So if you are calculating variable overhead, so the labor rate and the labor hours and the variable overhead hours will be same. Okay. So how much will be the answer now? Standard rate 5, actual rate 4, actual hours 1800. So what will be the amount? 5 minus 4, 1 into 1800. Answer will be
1800,
1800.
1800 favorable, sir.
Favorable, because you favorable you can easily understand, because if 5 is the standard rate and but we have used 4 only, it means lower rate. Okay, means lower cost, it means it's favorable, right? So remember, here let's say we had a standard rate was 20, actual rate was 18, because we are hiring labor at lower rate. This is good, this is the favorable for us. But if you see in terms of variable overhead, sorry, in terms of material, we say that standard was 15, but we bought material for 18. We bought for higher price, so that means it is unfavorable, right? By the rates as well, you can come to know, is it favorable or it is unfavorable, right? So the way I'm telling you, first of all, the variance, and variance we are doing price variance first. Price variance, material, labor, variable overhead, same rate, same formula. Now let's see, I will use another. I will use a sales price variance, right? So here, sales price variance, right? So sales price variance, of course, I should use here sales price, right? Here I'll use quantity sold, right? Am I right? Quantity sold, basically same quantity, right? Means formula is again same. Here I was using the what? Sales price variance, right? Sales price variance. Here, the sales price variance, same. So standard price,
Actual
actual
price
price,
means.
and here actual quantity sold. Ready? So let me change this one as well. Standard price, actual price into actual quantity sold. Basically, change in price into quantity, right? Change
सेल
in
में
price.
रिवर्स नहीं हो जाएगा सर?
हाँ,
Actual minus.
ये रिवर्स कर सकते हैं. Yes, Farid, understand that we can do reverse. Reverse क्यों करेंगे इसमें? If you want, if you see in the book, formula will be same what I wrote earlier, right? This is the formula you will find in the books. But if you want that, if your answer is coming positive, just like here, it was negative, it was unfavorable variance. It was what? Unfavorable variance. Here it is coming positive, it is coming favorable variance. And similarly, we have in the variable overhead, we got 1800 amount is 1800 positive, it means it's favorable variance, right? If you want to continue the similar way, that if it is, you don't want to think more, you say, okay, if it come positive, it means favorable. If you come negative, it right, it will be it come in minus, it will be favorable. So what we can do now in this case, we will do instead of standard first, we will keep the actual first, right? We keep the actual first and standard later. Did you understanding this point? Sorry?
Can you repeat, sir?
Simple way, in the cost variance, keep standard first, standard minus actual, right? In the revenue variance, keep the actual price first, right?
Okay, yes, sir.
Because
I
here,
understand.
why we keep this? Because we do know that if actual price increase, this is good for us. Price sales will increase, right? Actual price increase, sales increase, it is favorable. But if you consider the cost variance, if material price increase, just like 15 become 18, this is not good for us. Negative, right? Whereas if labor rate decrease, or here similar variable overhead rate decrease, this is good for us. It means in the cost, if the price increase, that's not good. But in the revenue, price increase, that is good for us. Farid, you understand this point?
Yes, sir.
Yeah. Saqib, you have told me the right point. So here we discussed about actual price minus standard price into actual quantity. So if I say, let me change that quantity, number of quantities sold, let's say we have 3000, right? And here we have 2500. And let's say the rates are basically what we have. We have 80, standard rate, actual rate is 85. Okay, this is the thing. So how much will be our sales price variance? How much is the actual price? 85. How much standard price? 80. How many actual quantities sold? 2500. So we can do easily, all right, 85 minus 85 into 2500. So what will be the amount then? Variance will be what?
12,500 favorable.
12,500 favorable. Understand? 12,500 favorable. So this is what we come to know. This is our price variance, right? So material price variance, labor rate variance, right? Variable overhead. We call it spending, right? So remember this point, there's a little change. Labor rate variance we call, but variable overhead we call expenditure spending variance, right? So again, I'm coming back here. This is our formula, what I told you. Variable overhead we call expenditure variance, right? Or spending variance we call. So this is the same. It means these price formulas for basically types of this inputs and outputs. So we are using the price formula, material price, labor price, variable overhead price, sales price. Formula is same. Formula is same. So have you learned the formula? Saqib, right?
Yes, sir.
Listen, the way I'm telling you, because what happened normally in the book you will follow, there might be so many formulas, student get confused, right? How many formulas to remember? That's why I am following the standardized system. that price formula, 4 of them, the same formula is working. Now let's come to the quantity formula. Quantity formula, here is the material quantity variance. Here is the material quantity variance. So material quantity variance, here was change in price, right? In price variance, it was change in price. Here it will be change in quantity. Am I right? In the quantity formula, it will be what? Change in quantity into standard price. Right? Here it was into actual quantity. Here is into standard price. Opposite. Right? Exact opposite we are going. Over there, it was change in price. Now we are doing change in quantity. Over there, it was actual quantity. Now we are doing standard price. Right? Because in the quantity, you will use the standard price or standard rate. In the price, you will use the quantity. Right? Into what? Actual quantity. It means if you are calculating the price variance into actual quantity. If you are calculating quantity variance, now here it will not be actual quantity. Here it will be what? Standard rate. Right? So this is the formula we will be using. Let's come here. This is the question. This is the question. Now we want to calculate the material. We want to calculate basically the same variances, but we want to calculate basically the material quantity variance. Material quantity variance, right? Or we also call material usage variance. Right? Okay. What is the formula? Anybody remember the formula? Data is same. Data is same. Data is the same we are using. This is the data, right? Same data we are using. So what is the formula for material quantity variance?
Actual quantity minus, standard quantity minus actual quantity multiplied by standard rate.
Standard quantity minus actual quantity, right, multiplied by standard rate, right? If you are calculating quantity variance, so the multiply will be what? Rate. If you are calculating the price variance, multiply by quantity, right? Remember, easy thing to remember. Now, let's keep it here. So it means I will use what? Standard quantity, actual quantity, and standard price, right? Because change in the standard quantity minus actual quantity into standard rate or standard price, same thing. So yes, what is standard quantity we have?
1000.
1000. Standard quantity is 1000. Actual quantity is how much?
1200.
1200.
1200. Standard price is what?
15.
15. So actual minus standard, what will come?
Minus 13.
Minus 200 times 15. What will come here?
3, sir. 3000.
Right? So remember this point. So material quantity variance, this is the same. Now labor rate variance, how we will calculate labor rate now?
In this case, we should also put actual quantity first.
No. In material, labor, variable overhead, these are our cost, right? In cost, standard will come, right?
Standard hours minus.
Actual come only with the revenues first.
So this is unfavorable because the variance is minus 3000. This is unfavorable then.
Yes.
You can see
Yes, sir.
we are using more hours, right?
Yes, sir. More quantity we are using.
More quantity of raw material we are using, right? So remember here we are assuming that same number of finished good they are making. What? Right?
Same.
This is material quantity. Let's say 1000 good, right? But let's say if you are making like quantity production. same quantity of standard and actual. Am I right? Right. So,
Yes.
right, the standard production, what was set, and same actually we produce. We are assuming here. Understand? Yes. What will be formula for labor rate variance now?
Standards minus actual hours.
So we will do what? Standard hours
Minus actual.
minus actual hours into what?
Standard price.
Standard rate. Right. How many actual hours we have?
18.
1800. Standard hours 2000.
2000.
Standard rate
20.
20. So what will be? It is favorable or unfavorable?
Actual overhead. Unfavorable.
Sir, this is unfavorable, sir.
Why? Because we are having
We're consuming more hours than the
more hours,
standard.
right? Remember, production is same, right? Production, same quantity, same quantity. This is very important that you should know that production, what was planned, what was standard, same we produce in actual, right? So, but material we use more or labor hours we use more, that is unfavorable. That is unfavorable. Okay. So here, let's come now in variable overhead. Yes, how will do? Same, right? The same. Same. Standard hours minus actual hour into standard, better, right? Standard over variable overhead rate, right? Standard variable overhead rate. Variable overhead rate. So how many standard hours we have? Same.
Same, sir.
Actual 1800
5.
and here is the standard rate is 5. So how much will come then? Is equal to 2000 minus 1800, that is 120
No,
multiplied.
sir. 1880.
Wrote wrong. 200 into 5, that will be how much? Here is coming positive or negative?
Actual less. Favorable.
Favorable. This is favorable. This is favorable, right? Okay. Sales price variance, right? So sales price variance. Now we have basically, let me adjust these things. Material quantity variance, labor, we call labor efficiency variance, right? The above one was the rate. Now we call efficiency variance, right? So it means labor quantity variance, basically we call labor efficiency variance, right? And if we say variable overhead, right? Variable overhead, what we will call volume variance, right? Or variable overhead efficiency variance. So labor efficiency and variable overhead efficiency variance will calculate. So variable overhead, let me efficiency variance, right? Variable overhead efficiency variance. This is what we discussed. Finally, we are coming to the sales volume variance, right? So finally, we are coming to sales volume variance, right? Sales volume variance formula is little different, right? Is little different. Let me tell you. Sales volume formula is what? Sales volume formula basically it is change in quantity same, right? Change in quantity is same. It means I will say standard quantity or
Actual.
actual quantity first. Actual quantity minus standard quantity, right? Multiply by. Now here is different.
Contributions.
Here standard contribution margin. Please understand now here point. If they say that you are using variable costing, here it will be standard contribution margin. You know, standard margin means standard profit, right? Standard profit, right? If you say standard profit means a sales price minus material price, labor price, variable overhead price, and fixed price. This is called there. But if you say contribution margin means sales minus variable cost only, sales minus only variable cost. So for that we should need basically in calculating sales price variance, sales price is given, but additionally we need the contribution margin, right? We need what? Standard contribution margin. Let's say if the standard contribution margin is suppose 20, suppose, right? Or don't suppose. See here, how much we have material price? Standard 15. Okay. Labor rate 20. Become what? 35. Variable overhead 5. Become what? 40. Okay. So how much will be standard contribution margin? Standard is 80. Okay. Standard contribution margin will be what? 80 minus, I think it was first one was 25.
40, sir.
18, sorry, 15, 25, right? 15,
40.
25. I am deducting all so that easily you will remember, right? Minus 15 minus 20 minus 5 is equal to 40. Am I right? Understand? So standard contribution margin means simply, right, standard contribution margin. What? Sales price minus material price minus labor rate minus variable overhead rate. Am I right? So I have written all. So 80 minus 15 minus 20 minus 5. This is standard contribution margin.
We will not minus fixed overhead.
This is what I'm telling you. Mostly, when you're calculating the price variance, you take the standard contribution margin. But here it will be, if they mention that company is using absorption costing, right? So absorption costing, so we will use standard margin. In this case, fixed overhead also we will minus. You got the point?
Okay.
So this you should remember, right? This you should remember what question says. Mostly it is standard contribution margin. But if it will mention, if a company use absorption costing, you should use a fixed overhead rate as well. Understand?
Okay.
So anyways, how we'll calculate now? What is our formula for sales volume variance now, right? Sales volume variance, right? This is the sales volume variance formula, actual quantity, right? So let me keep here actual quantity, then here standard quantity, here standard contribution margin. Okay, how much actual quantity we have? Number of units sold, actual quantity 2500. Standard quantity, how many units sold? 3000, right? And standard contribution margin, how much we have? 40. Am I right? 40. So easily we can see, right, increase in quantity, basically it's a decrease in quantity, right? So actual was less, right? Sorry, multiplied it. 500 minus 3000, right? And particular have a 40. That will be how much?
20, 2000, 20,000.
20,000, right? So minus 20,000 is our sales volume variance, right? So we discussed today all the formulas, right? Material. So I tried to tell you in a way so that you can easily understand, right? We created our own question, right? What I told you basically, you should remember that this is the main thing, sales price variance, right? So price variance formulas. Okay. Basically, we have, yes.
Can you go to the sales volume variance, sir? I need to note it down. Sales volume variance. Okay, sir.
So we have here, I told you already, that same quantity, right? So material, labor, variable overhead, and sales variances we have done. Fixed overhead variance are little different. So that we will also do it if we get time today. Let me go ahead. We should do some practice. Okay. Here. Let me go through your book, right? So you can understand flexible budget variance. We discussed already, right? All things we discussed, flexible budget variance. This is the explanation is there. I will send you the theoretical notes for those. Static budget variance we just saw, and here is the flexible budget variance. This is a huge detail that is there. Direct material variance, direct labor variance, etc. Huge detail is there, but I believe that what you should do. So what I am telling you. So we have done up till the those direct labor variable, right? Direct material variance. All.
Please see that sheet that has the formulas.
Yes, I will send you. Don't worry about that, right? So basically, what I tried to tell you today is that you should understand that basically there are two formulas for material, labor, variable overhead, and sales price, right? One formula, and you can it works basically for four: material, labor, variable overhead, right? Whereas similarly, quantity formula, basically quantity formula will work for three rather, right? Because only little change is there in it, that standard contribution margin comes, otherwise it is the same, right? So let me, if we come to some questions now. Okay, now we are doing the variance question. The purpose of identifying manufacturing variance and assigning responsibility to a person department to a should be to use the knowledge about the variances to promote learning and continuous improvement, right? So learning and continuous improvement, basically we are looking the learning curve, not the where this trace the variance to finished goods so that the inventory can be properly valued at year end. Right. So what is the question? The purpose of identifying manufacturing variance and assigning the responsibility to a person department should be to use the knowledge about the variances to promote learning and continuous improvement in the manufacturing process. What is C? Determine the proper cost of the products produced so that the selling price can be adjusted. Pinpoint the fault of operation problems in organization. So answer basically, if you see all of them, the A relates the right answer, right? So because once we do find out the variances, we will see that we'll understand the learning, and then once we'll understand that the for example unfavorable variance coming, so we will try to bring an improvement. So this is the main thing that we have. Okay, question number 2, difference between standard cost used for cost control and budgeted cost of the same manufacturing effort can exist because standard costs represent what costs should be, whereas budgeted costs are expected actual costs. So standard cost we have already seen. I told you, let's come here in the Excel sheet, or let's say in the PowerPoint as well. I told you when I say this is our standard cost. The cost should be like this, right? So standard cost means what we planned, right? And where is the, if you see the budgeted cost, right? It will be what is expected according to actual. So understand the difference. Standard cost, what cost should be, whereas budgeted costs are expected actual costs. So remember, sometimes people like get confused in a standard cost and budgeted cost. So what do you understand, for Farid, in this? What is standard cost and what is budgeted cost?
Well, standard cost is basically, I mean, it should be. Yani it's no, we should have this cost, whatever the cost we assign, we have set, what standard we have set, it should be. Company should have that
Basically,
standard.
in budgeted cost, we are using flexible budget.
Hmm.
Flexible means we are using actual quantity,
Yes, sir.
right? So we are using actual quantity. In standard, like this is standard, this is actual, and this is static budget variance. Whereas if you go ahead, this is here we find out the flexible budget variance. How we find out? Because first of all, we will flex the budget. Flex the budget means whatever we having actual 16,500 units, we will multiply by each of their rates so that we will find out the actual values. Once we find out the actual values here, we can minus with the actual with the flexible, we will find the flexible budget variance. Or simple words, what is this question is very, very important. Remember, distinction between standard cost used for cost control and budgeted cost of the same manufacturing, right? So standard cost used for cost control, we have already set our standard, and that is standard cost. With budgeted cost based on the actual, based on the actual. Okay, so remember this thing. Static and budgeted, static and flexible budget variance. So can you try to solve this question? See this. Simpson Company master budget shows straight line depreciation on factory equipment of 258,000. The master budget was prepared at an annual production volume of 103,200 units of product there. This production volume is expected to occur uniformly throughout the year. During September, Simpson produced 8,170 units of product. So how many units they produce? Simpson produced 8,170 units there, and the accounts reflected actual depreciation on factory machinery of 20,500. Right. So this is the monthly. This is only September values. Remember. So during September they produced 8,170, and the account reflected actual depreciation factory overhead was only for September. It was 20,500. Simpson controls manufacturing cost with a flexible budget. The flexible budget amount for depreciation on factory machine for September. So what will be flexible budget now? Remember one thing. When you're preparing flexible budget, you will flex the budget, right? Variable cost you will flex according to per unit basis or per hour basis, right? Whereas actual cost, fixed cost, you should allocate on the monthly basis. Especially you have depreciation. So depreciation, they have already mentioned that straight line depreciation, right? They're using on factory equipment, right? And they mentioned that straight line on factory equipment of 258,000. So with this thing, so 258,000 is the cost, and if you divide by 12 months, how much it will be?
8,600.
258,000 divided by 12. How much is coming? 21,250. Am I right? What is it? Our factory equipment cost is 258,000. 258,000 is the depreciation yearly. But we are calculating only for September. Only for September depreciation. So we will divide by 12 months, monthly will come. Students get confused. What students start using that say, okay, right, because 8,170 units. So what they do, 258 divided by number of unit, they find out the per unit basis, right? Per unit basis, they will do it. And then they will multiply by 8,170. If it is mentioned that depreciation is charged on the unit basis, then you can calculate like this. But here it is mentioned flexible budget. Flexible budget amount for depreciation. So if they mention flexible budget amount, remember you have to, when you are flexing the budget, when you are flexing the budget, so how you flex the budget, basically you flex the budget according to a number of units. For example, if I say, let me create simple value, right? We have material, right? And here is mentioned cost quantity, right? Standard cost per unit, right? You should always find out this thing. So if it is not mentioned, just like if I show you here, see this now. If I see this particular thing, right? How I can make the flexible budget? Let me do one thing. That if I'll bring this data, oh, in Excel, it will come in the table form. Okay, what is it? Anyway, it's not coming. Okay. Actually, it came in one sheet. Okay, now what I want to tell, we have this basically actual results we have, right? And we also have here how we can calculate this flexible budget. This is the important thing. This is the important thing, how these values came, how these, especially flexible budget, how these values came. Basically, we have this data, actual results we have, right? We have one actual results. The other we have static budget. Two things we have here, right? We have two things. And with that, we have to make our flexible budget. With that, we have to make our flexible budget. So how can I make the flexible budget? Basically, let me do one thing. Let's erase these columns. Okay, this is the situation we have. If I'll deduct this one as well. It's not deducting. What is happening? It's not deducting. Neither it's deducting nor the column is deleting. Okay, fine. So what I want, that if I want to calculate the static budget there, first thing what I will have to do, I will have to find out the per unit, right? I will have to find out the per unit. How can I calculate per unit? 2160,000 divided by how many units? 18,000. Saqib, are you getting this point? First of all, if I want to calculate anything, right? Or
Yes,
let
sir.
me, I think, create a simple thing. Okay, this is our actual results, right? This is our standard. Okay, with that, basically, we have to make a flexible budget, right? We have to make a flexible budget with that. How we can calculate the flexible budget with that? First of all, find out standard cost per unit. Standard per unit. I'm not writing cost because the revenue is also there. Per unit. Standard per unit. So in terms of revenue, how much will be standard per unit? Everything you have to divide by number of units, right? So what we have here is equal to 2160 divided by 18,000. 2160 divided by 18,000. How much we get? 120. Is it right? What will be material cost per unit? We are assuming same number of units sold, right? And produced. So if I want to calculate, I will calculate what 911 250, that is the standard material cost, divided by 18,000. This is 50.64. Now if I want to calculate now per unit, we have done per unit. With that you will calculate the flexible budget. Flexible budget. How you can calculate flexible budget? Simply actual unit. We do know flexible budget, actual into standard rate. Actual into standard rate. So actual units are how many? If I'll calculate here, actual unit basically we have 16,500 multiplied by standard rate is 120. How much we're getting? 120. Is it? Amount is same. 2,160,000. 1947. Okay, fine. This is flexible budget we got. So how we can calculate flexible budget variance now? Taxable budget variance, right? Simply how we can calculate uh, actual minus standard, flexible, right? So flexible budget variance will say that in terms of revenue, right, actual sale is less and flexible is more. So it will be favorable or unfavorable.
And unfavorable, sir.
So let me repeat again. Here, basically, let me delete this all. Okay. So here is the data we have. So we can easily see that units sold, basically we had how much units sold we have here 16,500, right? 16,500 and revenue was 1947. I kept the same, right? And then material, labor, variable overhead cost, I kept the same. So, and there was two things mentioned, right? Actual, if we have actual data, and the other we have the standard data. So first thing we have to find out is standard cost per unit, right? Standard cost per unit we have to find out. So that we find out how 2160 divided by 18,000, this is coming 180. 120. So if you want to calculate flexible budget variance, right, what I should do in flexible budget variance, basically actual quantity times standard price. Okay. Actual quantity into standard price. So actual quantity is 1600 for 500 and standard price is 120. And how I'll calculate flexible budget variance? I will calculate, right, actual minus flexible budget. Flexible budget. Okay. This is the way I will be calculating my things. Okay. Understand? So first I find out 120, then 1600 into 120. Now I'm looking for material. Farid, can you tell me how I can find out the flexible budget value for material?
Yes, sir. Sir, standard material cost divided by 18,000
Standard units, right?
multiply by 1,600. Yeah, this is the rate, sir. Can please multiply it with 16,500 and you will be
Right.
having
So
flexible.
actual is right. The current is this, right? So what we'll do
Yes,
is equal to 16,500 times
yes,
material 83531, right? This is there. So this is basically we got flexible budget. So how I can calculate flexible budget variance?
sir. You will minus actual from flexible budget, and
Yes.
this is
So
I will.
actual minus the flexible budget.
Yeah, this is favorable.
Favorable variance, right? This is the way we are calculating. Same way we will calculate for the labor, that is 297,000 divided by 18,000 standard, we got 16.5 rate, and that because actual we should multiply. So I will do 16,500 times, I will do what? 16.5. Okay. Saqib, can you tell me the last one?
Same, sir.
Same what?
172
Yes, divided by
800 divided by 18,000.
18,000. Rate came 10.
9.6 multiplied by 16,500.
16,500 times 9.6, right? And then finally, how I'll calculate flexible budget,
This one actual minus flexible.
right? This is what we basically we have done. This is called flexing the budget. What is called? Flexing the budget. Basically, we flex the budget. Basically, we flex the budget. You can see I have taken up till variable cost this thing. If I say what will come if I calculate contribution margin, right? So we know sales value minus all this stuff. This is called contribution margin. If I say, let's total this all, these three all. Let's total this coming this. Then let's copy this. Okay, this is the value. So if I want to calculate now contribution margin, what is the formula for contribution margin?
Minus variable cost.
Sales
Sales
minus
minus
variable.
variable
This
cost.
is sales minus total
Variable.
Yes, sir.
660,000, right? So this is our contribution margin, right? We have same values, 66. Yes, fine. Okay, and same. Let me copy this all, right? If I copy here all, these are the values, right? These are the values we have. Contribution margin values, we got it. Additionally, if you see, they have been given total variable manufacturing overhead, total variable cost, contribution margin. This is what we have done. Fixed overhead. Here is mentioned fixed overhead 429,000. Let's write here fixed overhead as well. Fixed overhead. Fixed overhead is mentioned here. How much? 429,000. Okay. Here is mentioned standard as well. Static, how much mentioned? This is mentioned 450,000. Okay. I will calculate the flexible budget. Yes,
It will remain the same for fixed overhead, sir. 450,000. We will not change anything.
it will not change. Are you sure?
Yes, sir. Yes, sir.
If it is yearly, it will not change, right? It is yearly, so flexible budget, we will have same 450,000, and then there will be variance coming. How much variance will be coming now?
Then it will be favorable 21,000.
Hmm?
Favorable 21,000.
Favorable 21,000. That we will calculate, right? So this will be favorable variance. So we can minus 429 minus 50. Actually, our cost is this. This will be favorable variance we have, right? So understand this. there. Actually, this is a, if we will say that if the data here, the data is given for the year only, right? But had they mentioned that monthly budget, right? So if they ask for 1 month fixed overhead flexible cost, how much you will calculate?
Divided by
What divide? 429
period.
divide 450 divide. Hmm? I explained too much thing because of that. Because of this one question, I explained you huge things, right? Because here you can see they mention company master budget shows straight line depreciation 258,000. This is the master budget. This is the master budget. So it means we will be master budget. We'll see. So we will take the standard values, not the actual. Okay, remember. Anyway, let's come ahead. Here there is another question, that is Bain's Corporation expected to sell 150,000 board games during the month of November, and the company's master budget contained the following. This is the data is being given to us. Let's see the requirement first. Actual sales during the November were 180,000. This is the budget, right? 150,000 unit budget. This is 150,000 unit budget, but they are saying that during November, right, actual sales during November were 180,000 games. Using flexible budget, the company expects the operating income for the month of November to be. So what will be the operating income according to the flexible budget? According to the flexible budget. How can we can do this question? Yes. What is it? This is the question. So 150,000, right? How we can calculate this? Basically, they're asking us the flexible budget. They're asking flexible budget. You should know that basically contribution cost is 975, right? Contribution cost is 975,000, and this is the cost of how many units given? This is the cost of how many units?
150,000.
150,000, right? So instead of doing each divided by 150, 150, just like we did here, right? Each we were dividing by 180, then 180, then 180. If you want to know final thing, right? So you can directly divide by, you can take contribution margin and divide it by 150,000. So what it will come then? So
So it's
contribution
gonna be 1,170,000.
6.5 per unit, right? So what is coming? Contribution margin per unit. Contribution margin per unit coming 6.5. So how many units we are manufacturing?
180,000.
180, right? So number of units MFG. So 180,000. So what value will come now here?
Sir, 1,170,000.
So 1170,000 is the contribution margin, right? Contribution margin, right? We have got it. Total contribution margin came how much? 1170,000. Now fixed overhead is given how much? Fixed overhead 250 and 500. That is total how much? Yes. So they did not give the production separately. So we'll assume same 150 is there. So anyway,
Yes.
fixed overhead. Overhead. How much we have fixed overhead?
250,000.
No, fixed overhead 250 and fixed selling and admin. because they are asking what is the net income, right?
Yes, sir.
Operating income, how much? So operating income include selling and admin as well, right? So we will take 750
Yes, sir.
divided by how many units? Because here it's saying that November divided by how many units?
150.
12. Divided by what? 12. Why 12? Why 12? Because fixed overhead mainly we calculate on monthly basis, right? So you will
Period cost.
calculate by 12. So what will come here? 750 divided by 62,500, right? So 62,500 you can add up here. What is the answer now?
No, sir, why we are adding it? We should minus it. It is, sir.
Yeah, this is a fixed overhead. This is minus. You should do minus, right? So is equal to
Sir,
what?
by the way, this master budget is for November only, sir. I think. Can you go up? You can check.
150,000 is
For
for.
November, sir. This is for November, so we will not change the fixed overhead cost.
Okay,
It will be
fine.
750.
What they have given yearly. You're right. You're right. So we will not divide by 12, right? So how much is the fixed overhead we have? So we have contribution margin this much, so we'll minus the 750 only, right?
Yes, sir. So 420 is
750,000.
down.
So that will be how much? Let me
420.
add up. 420,000, right? 420,000. We got it. So how we calculate it? This is our fixed overhead and this is our operating income. This is our operating income, right? So how we calculate it? Remember this thing that you have they given the monthly or this they gave only November. This is the monthly. So monthly they have given. So we calculated first of all contribution margin divided by number of units. This budget is for 150. So 975 divided by 150. We got 6.5 per unit contribution margin that we multiplied for the next month 180,000. So we got 1170,000 budget, right? Contribution margin, budgeted contribution margin for November. And fixed overhead they have given because this is the only November fixed overheads. So we'll minus all 750. That will be operating income of that month. This is what we discussed, right? Anyway, here let's see some more questions. Or better, I will send you this file, right? Try to do it and then next class we'll continue the same. Do you want anything to ask today?
No, no, sir. Thank you, sir.
No?
Sir.
Okay, good luck. Right, I will send you these files right now and then you can continue, right? Please practice more, okay? Good luck.
Let's
Bye-bye.
send the formula, sir. Formula sheet also.
Yeah, formula sheet is very important. I'll send you. Don't worry about that, okay? Take care. Bye-bye.